And because there's no highly paid manager in a fancy suit, think of a fund like a potluck dinner, 30% of your lifetime wealth before you even retire. One is for high-stakes gambling. An index fund just buys all 500. Microsoft or Amazon might have a great one, and you're still safe. They want to find the next big thing before the rest of the world does. They use leverage, borrowed money, to make massive bets. For 99% of people, including you, index funds or ETFs are the absolute winners.
Uncle Mike, I'm trying to invest my savings, but I'm lost. My TikTok says buy index funds. My bank says mutual funds. And I keep hearing about billionaires in hedge funds. Is it all just a scam?
It's not a scam, Jack, but it is a financial jungle. If you pick the wrong fund, the fees alone could eat up 30% of your lifetime wealth before you even retire. One of these is designed to keep you safe. One is for high-stakes gambling, and one is the Swiss Army knife of investing.
I just want to know which one actually makes me money while I sleep, without me having to become a Wall Street expert.
Then let's break it down. Think of a fund like a potluck dinner. Instead of you buying every single ingredient for a 10-course meal, 100 people chip in money, and a fund buys the whole feast for everyone. You get to eat a bit of everything, and you share the risk if the cake collapses.
Okay, let's start with the one everyone talks about. What is an index fund?
An index fund is passive. It doesn't try to be a genius or predict the future. It just copies a list. Imagine a scoreboard of the 500 biggest, most successful companies in the US. That's the S&P 500. An index fund just buys all 500.
So nobody is actually picking the winners?
Exactly. And because there's no highly paid manager in a fancy suit, the fees are almost zero. It's low risk because you own the entire market. If Apple has a bad year, Microsoft or Amazon might have a great one, and you're still safe. Here is a case study about the Warren Buffett $1 million bet. In 2007, billionaire Warren Buffett bet $1 million that a simple, cheap S&P 500 index fund would beat a group of elite, genius hedge fund managers over 10 years. After a decade, the index fund returned 125%, while the genius managers only made 36%. The lazy way won by a landslide.
So if index funds are so good, why do people still use mutual funds?
Mutual funds are active. There is a professional manager trying to beat the market. They want to find the next big thing before the rest of the world does.
That sounds like a better plan. Why wouldn't I want a pro handling my money?
Because pros are expensive, Sam. They charge an expense ratio, usually 1% to 2%. That might sound small, but over 30 years, that fee can take away hundreds of thousands of dollars from your retirement. Here is another case study about the Peter Lynch era. However, sometimes it works. In the 80s, Peter Lynch managed the Fidelity Magellan Fund. He was so good that he averaged a 29% annual return. If you had invested $10,000 with him, it would have turned into $280,000 in just 13 years. But remember, only about 1 in 10 managers are actually that good. Most of them just take your fees and lose to the index.
What about hedge funds? They sound cool, like in the movie Billions.
Hedge funds are the Wild West of finance. They aren't for regular people. You usually need to have a net worth of $1 million just to be allowed in. They use leverage, borrowed money, to make massive bets.
Why would anyone take such crazy risks?
For the legendary rewards. They use the 2 and 20 rule. They take 2% of your total money every year just for existing, and 20% of all your profits. It's the most expensive way to invest in the world. Here is another case study about George Soros breaking the bank. In 1992, hedge fund manager George Soros bet that the British pound would crash. He was right. In a single day, he made $1 billion in profit. One day. I want to share with you another case study about the Melvin Capital disaster. But it cuts both ways. In 2021, during the GameStop craze, a giant hedge fund called Melvin Capital bet against the stock. Regular people on Reddit fought back, and that hedge fund lost $6.8 billion in a single month. They had to be bailed out. It's high-octane gambling.
You mentioned ETFs. How are they different from the index funds?
ETFs, exchange-traded funds, are the modern hybrid. Think of them as an index fund that has the speed of a stock. You can buy or sell an ETF in a split second at 11 a.m. on your phone. Traditional index funds only let you trade once a day after the market closes.
So ETFs are just faster, more flexible versions of index funds?
Exactly. And you can get incredibly specific. Want to invest only in artificial intelligence? There's an ETF for that. Want to invest in solar energy or video games? There's an ETF for that too. Last case study I want to share with you guys, the ARK Innovation ETF. Look at Cathie Wood's ARK Invest. Her ETF focused only on disruptive tech. In 2020, it went up over 150%. Everyone thought she was a genius, but a year later, as interest rates rose, the fund crashed hard. It's a reminder that even modern funds can be a roller coaster.
So, Uncle Mike, bottom line, if I'm just starting, which one should I pick?
For 99% of people, including you, index funds or ETFs are the absolute winners. They are cheap, they give you instant diversification, and historically, they beat the pros in the long run. Leave the hedge funds to the people who can afford to lose their shirts.
So, buy the whole market, don't try to outsmart it?
Exactly, Sam. But I want to hear from you. Are you a set it and forget it index investor? Or are you trying to find the next 100x winner? Let us know in the comments below.
I'm going with the S&P 500. If it's good enough for Warren Buffett, it's good enough for me. Don't forget to subscribe for more secrets to the money game.
Stay smart, stay invested. See you in the next one.